Today's video, I'm going to answer or do an investment analysis of IBM after it announced its. Though I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, Spotify, SoundCloud, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. To subscribe and hit the notification bell if you're watching on YouTube, so you're notified every time we release a new video, and release new videos all the time. Okay, so IBM the other day, about a week ago now, as I'm recording this, announced that it was going to spin off a business. It was going to keep its cloud and AI business that's growing rapidly in one business, in the IBM kind of mainline business, and it's going to spin off its IT infrastructure services and kind of old school hardware business into another entity sometime before 2021. I don't know, have any idea why. They just said by the end of 2021. I have no idea why this process takes so long, but we're going to cover this today because I'm assuming over the coming months there's going to be more information about this. So I'll update the case study, but I want to give you my thoughts on this, on IBM as a potential investment and potentially investing in this spinoff situation now, based on the information we have now, because they also just released third quarter earnings on the 19th, which you can see below, which is 3 days ago as of this recording. Another reason I want to do this is because, frankly, big time spinoffs don't happen very often. So this is fascinating to me. Actually, when I first started investing in special situations, spinoffs, going private transactions, those kind of things, after reading Joel Greenblatt's great book. What is it? You too can be a stock market genius, where he talks about special situations. Some of my best investments have been in special situations, and frankly, I haven't even looked at one in years because there hasn't been one that I've been even remotely interested in until this IBM one. So what you're seeing here is its earnings presentation and its earnings report. This is not the actual full earnings report. This is a press release, because frankly, it has most of the important information in here. So we're going to go through these. I'm going to tell you what I think of IBM based on what it says here, and also Morningstar, which we're going to go to in a little bit. Okay. So it's splitting its business off into two entities. It bought Red Hat. IBM bought Red Hat last year to transform its business. Its mainline kind of old school business has been declining for years in terms of revenue. So it bought Red Hat for $34 billion last year. And Red Hat is a hybrid, quote, a hybrid cloud company. I'm not going to get into the technical terminology in this video. So if you want to look it up, feel free to do so on your own. But to try to stay out of the minutia and just try to stay to the investment analysis part, I'm not going to get into a lot of the technical details in this video because, frankly, they're boring. So, but Red Hat is in the hybrid cloud industry, which is a huge opportunity. Of course, you see this kind of stuff in investor presentations all the time. $1 trillion opportunity, blah, 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 blah. It's growing 16%, or growing revenue 16% per year. That portion, or the Red Hat company alone, the entire cloud business at IBM is growing at 19% per year, which is fantastic, especially for a gigantic company like IBM, especially when its revenue has been dropping for years, maybe close to a decade now. We'll see that when we get to the Morningstar numbers. Ton of cash on its balance sheet, usually a good thing. This goes over their different business lines. Scanning through this real quick to see if there's anything important I want to talk about here. Most of it's on this other sheet, and also the Morningstar page that I want to talk about. And I'm going to pause and bring you back, actually, so you don't so you're bored out of your mind watching this. Okay, finally found something interesting. So IBM, old school IBM revenue has been falling for years, and it's still as a whole falling, but cloud revenue is up in the year-to-year period and also in the quarterly period, or in the 9 months period, 9 months of this year, sorry, and also the quarter-to-quarter period. What's the star? Recast to conform with 2020 presentation. Not quite sure what that means. Oh, maybe there were some final number adjustments at the end of last year. Nothing really major here. Costs are rising, not a great thing, of course. This is interesting. So there are also the cloud and cognitive business line they're going to be spinning off also has the highest gross margin of any business they have as well, which I didn't realize. That's fascinating. Hopefully they have that same down here for operating profit as well, which it does not look like they do. Okay, a lot of cash, a lot of goodwill. We talked about in the last couple of videos. Not necessarily a good thing, frankly, mostly useless. There would be some value here, most likely, but still, that's most of this is not worth anything in a real world economic sense. If you want further explanations on those, check out the I think it's the AT&T analysis I did, and also what was the other one? Checking on my other screen here what the other one was. The analysis of T-Mobile, and I think I did one on, or I know I did one on Cody, but I think I talked about goodwill and intangible assets in those as well. So if you want more information on those, why I don't necessarily like goodwill, especially, and intangibles to me don't have much value, go to those videos. Debt, they have a lot of debt. Retirement obligations, long-term debt and short-term debt equal about 10.2, 1065, 81 billion-ish off the top of my head, which is a ton of debt for, we'll see what its market cap here is in a little bit, but that is a ton of debt. Okay, so this must be, the huge negative number must be from the acquisition of Red Hat, which makes sense because that was about for $34 billion. So net, that was probably about $3.2 billion or $32 billion. That's why there's such a huge difference here in the quarter-to-quarter period. Don't see much here. I thought there would be more in here that was interesting. Oh, here we go. This is interesting. So the cloud and AI has the highest gross margin, has the highest pre-tax margin as well of any of the business lines. Same here. This is 3 months, 3 months. Okay, so this last year, and this is this year. So its margin actually went up by a significant amount in the year-to-year period. And there's more stuff in here that I would find, but again, I don't want to bore you with some of these details. So let's get to the key ratios, or not the key ratios. We're getting to that in a second. The Morningstar pages. So it has a huge dividend. In the AT&T video, and I believe also the Exxon video, all of these videos that I've done in the past on the investment analysis that I've mentioned, you can find a link below this. In those videos specifically, I mentioned any stock that has a dividend yield above 5%, mostly a red flag, and you need to figure out what's going on. So that's the first thing that catches my eye here is the dividend of 5%. We need to figure out if that's sustainable, how they're paying for that dividend, are they issuing shares, are they issuing debt, all that kind of stuff. Oh, and its market cap is 103 billion versus about 81, 82 billion dollars in short-term and long-term debt, and also retirement obligations. So that's a massive number. Massive number. We'll go into more detail on that in a second. So here's what I'm talking about, the revenue decline. Declined pretty significantly over the last decade because their business, their kind of old school hardware / IT services business that they're spinning off is not growing. It's actually decaying. So that's a huge reason they're planning to spin that business off. This led to a decrease in operating margin and operating profits. For, again, a pretty significant drop in both. Drop in earnings per share while the dividend increased. The dividend is still covered by earnings per share, but the payout ratio has gone from 21.7% in 2010 to 73.6% in this year. They've been buying back shares, which is typically a good thing because most of this time they've been undervalued by most estimates. Book value per share is rising. Again, I told you why that was. That's mostly due to the increase in acquisition from Red Hat. So far, it's been an okay acquisition. Probably better than okay. After they do the spinoff, they can concentrate more. But the huge thing there is that it was mostly funded through debt, which again is not a great thing. Free cash flow is down in the last decade, not a huge amount compared to operating profit and income. ROIC, way down. This is one of my favorite metrics. I want this to be above 10% on a consistent basis. At the beginning of the decade, it was 30%, which is fantastic. Now it's 9.4%. So that's not great, obviously. The more money a company makes and the higher profitability it has on ROIC, the more profitable the company is, the more money it earns, and the higher likelihood it has competitive advantage. So you can see that not only has its revenue declined above, but also this is a good sign that its competitive advantages have declined as well, as its kind of mainline business has declined. Another thing here, comparing this to ROE, just comparing these two numbers, I can tell that IBM has a lot of debt. Again, we already know that because we looked at its balance sheet briefly, but just by looking at these two numbers in comparison to each other, you can tell that IBM has a lot of debt because because ROE is leveraged by debt while ROIC is not. Free cash flow to sales, I look for anything about 5% here. This is fantastic. Cash. So they have a lot of cash, but they also have even more debt. Their total liabilities as a percentage of the balance sheet is 86.7%, which is a lot. And it's even higher in a real world sense. Sorry, I don't know why it keeps doing that on Morningstar. Because of the intangibles we already talked about. And again, if you want more context into why I don't like intangibles, go and watch those other videos I talked about and that are linked below. But in a real world sense, I would discount this probably by at least 75%. The total intangibles, which we'll get to in a minute, which would probably put their total liabilities into the negative territory. Which, when that happens, when there's negative equity right here, that means the book value of the shares or the shareholders' equity, that means the same thing. That means essentially the shares on the market that you're buying, shareholders' equity, are worth less than zero, which is not good. But as I explained in a previous video in this series, it's not necessarily a real world applicable thing anymore because of this doesn't include their operations. This is just the value of their balance sheet. Debt to equity, I look for anything under about 1 for conservatism's sake. So that shows they have debt, which again, of course, we know. Cash conversion cycle, nothing really of major note there because that hasn't changed much. The quarterly numbers, and I don't know if these are updated numbers. I don't think they are yet on Morningstar, so some of the numbers from here are going to be different from some of the numbers we just looked at on the actual earnings, but this will still tell the story. So they have $14 billion in cash versus about $81 billion in debt. Not good. Again, a lot of that debt is from retirement obligations and also the Red Hat acquisition. This is also another troublesome number, the goodwill. Again, I would discount almost 100% of this number. Okay, so there's a net number. So yeah, this isn't updated. Actually, let me go look at the debt. It might be actually, because that's pretty close, and that doesn't include the 11 rounded up, 56. That doesn't include the long-term pension obligations either. So this might be updated. But either way, they have way too much debt for not only the size of the company, but also when you compare the debt level to their intangibles, or after you consider that I would discount the intangibles by about 75% here, because if they're a huge amount of debt, if and when I do that, and I would, their shareholders' equity number goes negative. Again, not a huge deal, but it's not a great thing typically. Again, for reasons I mentioned in the other videos. Now to valuation. And I'm going through this a little bit quick because I talk about some of this other stuff in the other videos. So again, that's why I mentioned if you want to learn more about specific things I'm talking about, make sure to go to those videos. So it looks cheap on a price to earnings, price to cash flow, and forward PE ratio. Frankly, I don't use these metrics very much. I use them as a quick reference, but in reality, I use EV to EBIT for my main relative valuation. Of course, I use EV to free cash flow, EV to owner's earnings once I get to that point. But at this visual analysis stage, this is what I use. And the reason it's EV to EBIT is so much higher than its PE and price to cash flow and forward PE is because this includes debt. PE, price to cash flow, and price to forward earnings does not, which is why I don't rely on those metrics very much, because most companies in the world have debt. And when you have an enormous amount of debt, that adds to your valuation. And the way I like to think of owning a stock is that I'm a business owner in the entire company. So I want to know about the cash, I want to know about the debt, I want to know about the obligations, which is why I use, again, enterprise value to EBIT, and even a more advanced version, total enterprise value to EBIT. What this shows is for enterprise value to EBIT, for a company to be undervalued, or for me to consider them to be undervalued, I look for anything above under 8 or below. On these metrics up here that I just talked about, I look for anything under 20 or below. So in a real world sense, once you consider debt, that means that IBM is fairly valued to slightly overvalued, kind of at best, in a real world business owner economic sense. That's what that means. So it's got a lot of debt. It's fairly valued to slightly overvalued, but it's still enormously profitable, turning out a ton of cash, and it's doing a spinoff. And usually after spinoffs happen, the stocks of both companies tend to skyrocket afterwards because they can focus more on their own operations. And people just like to speculate in spinoffs as well. Sorry, it's taking a drink of water. So what would I recommend for IBM right now? What I recommend for IBM right now, and before I say that, actually, I need to give a disclaimer here that I don't short stocks, I don't own any stock in IBM, and I don't short stocks. I have no personal interest in IBM other than doing this analysis for informational purposes. The reason I'm saying this is because it's on some of the other videos, people were making some weird, funny, nasty comments, depending on how you took them, about my lack of ability to analyze stocks, and saying I need to do more homework, even though I called that Cody was overvalued in last November, and its stock is down 8% since then, and I made an updated video, and people didn't like the new video. So this is for informational purposes. Again, I don't own stock in it. I don't short stock, so I don't have a personal emotional interest in this company at all. But from this visual look, which essentially it covers my visual preliminary analysis checklist here, which you can get access to the full preliminary analysis for free below that I do on all stocks that I look at. This is just the visual part. What I would recommend here, ton of cash, huge profits, spin-off are all positives. Huge debt, overvaluation due to the huge debt, negatives. So what I would recommend here is to wait on IBM until there's more clarity around the spinoff. What do I mean by that? So what I mean by that is that when a company does a spinoff, they can kind of pick and choose where they want their financial assets and financial liabilities to go. So they can pick and choose kind of where to put the goodwill, where to put the intangibles, and where to put the debt. Until that is known, I don't recommend buying IBM right now. If you already own it, hold your shares, because until that information is known, you might want to just hold on to both companies. We don't know until that information is out. But if you're looking to buy a new stock now, I wouldn't recommend buying it until more clarity is given on where the debt is going to end up, where the goodwill is going to end up, where the intangible assets are going to end up. Because as of this writing, or as of this recording, there isn't clarity on that. There's clarity on the kind of revenue split, which, if memory serves me right, and I don't have that up anywhere, I don't think, is there's going to be the mainline kind of IBM business, the AI and cloud business, is about a $50 billion a year business in revenue. And the old school kind of IT services business is going to be about a $16 billion a year revenue business. I think it was 16 or $19 billion a year revenue business, but that business already has $108 billion, or again, around that number. I'm sorry, I should have had that screen up as well, in backlog, which means they have revenue generation built out for, at current run rate, of about, again, $19 billion a year of almost 6 years. So it will depend a lot on, or the kind of prospects of each of these stocks after they spin off and split will be a lot affected, there we go, by which company is more indebted and where they put the intangibles and the goodwill. Again, until there's more clarity on that, I wouldn't recommend investing in this as a brand new investment. I don't know when that's going to come, frankly, because they said by the end of 2021 they plan this spinoff to happen. I don't know. It could be sooner. It could be later. They didn't really give much clarity on that at the quarterly earnings call. So until there's more clarity on the debt and those things I mentioned, the goodwill and the intangibles, I would kind of hold off, because frankly, it'll depend a lot. Where they put the debt and the intangibles and the goodwill will affect the profitability of each company substantially. And I value companies based on the profits and cash flows. So without that information, I can't even really put a fair value, even estimate, on either company, which is where we get back to the valuation and is it a good buy or not? Because, for example, if the AI, if they put most of the debt, goodwill, and intangible assets in the old line business, which frankly they probably should, especially with the goodwill and intangibles, and probably to a smaller portion of the debt, then the new company, the new IBM, could be a spectacular investment, because they would have low debt and their balance sheet would be really clean. If they kind of split it 50-50, it might be kind of an okay investment if they give it to the new business, which I don't kind of envision them doing. And again, I say they can kind of pick and choose where the goodwill, debt, intangible assets, and other assets and liabilities go. They can to a degree. It also depends on regulations and accounting rules and stuff like that. But there's a lot of wiggle room to where they can put stuff, but they still have to abide by those rules. So that a lot of that will depend on those kind of things as well. So what I'm recommending right now is, or what I think of this investment right now is, it looks potentially good, but it depends on where they put the assets and liabilities when the spinoff happens. So right now, I just kind of wait. If you own the stock, wait and just write it out for the reasons I mentioned. If you're looking to buy, again, I just wait as well. So I hope this helps. I hope this was interesting. I hope you find this of value. If you're looking to learn more about the specific things that I go into, like goodwill, intangible assets, stuff like that, make sure to check out the other videos in the series below. If you are watching on YouTube, make sure like, love, share, subscribe, comment, all that good stuff. I'm already going to make a video from a one subscriber or one commenter on YouTube. He asked me to look at US still for him, so I got that on the calendar to look at, I think, next week. If you want me to look at a stock, let me know in the comments below, and I'd look at a stock for you as well. The only stocks I will not look at are banks, because frankly, I don't evaluate banks. So, and also insurance companies, because they take longer to, you have to actually go into the financials to kind of get a good idea about those as well. But other than that, I'll look at any stock you want me to worldwide. Also, make sure to like, love, share, subscribe, and hit the notification bell so you're notified every time I'm releasing a video, and releasing new videos all the time. If you're listening on the podcast, like, love, share, subscribe, all that good stuff. We really appreciate a review after you download as well, because the more reviews, views, and listens we get, the more people we can help with our content. If you're also looking for help on how to become a better value investor faster, and how to evaluate stocks faster and better than most people, we have free resources below. We have 5 free resources, including valuation templates and metric calculations. Sorry. You can get that below. We have a 7 tips guide, 7 tips to picking great stocks. And you can also get my book, How to Value Invest, in a PDF form for free below as well. If you're looking for information on how and more direction on how to reach our goals in investing faster, we've also got a value investing masterclass with information below this as well. But until next time, have a great day. Talk soon. Bye.